You're not buying value, you're buying a system. Not all value ETFs are the same, and performance differences often come down to how value is actually defined. Over the past decade, growth stocks have dominated broad market indexes, shaping both investor expectations and returns. But as volatility returns and growth leadership becomes less consistent, many investors are revisiting value investing. The challenge is that value is not a single strategy. Even though ETFs may carry the same label, the way they define, measure, and construct value can be very different. A good example is comparing two major ETFs, Vanguard Value ETF, which tracks the CRSP US Value Index, and the SPDR Portfolio S&P 500 Value ETF, which tracks the S&P 500 Value Index. Both aim to capture value stocks, but their construction methods differ significantly. CRSP uses a more gradual classification system. Stocks are placed into value or growth segments with limited overlap. This creates smoother transitions, lower turnover, and more stable portfolio composition over time. S&P uses a ranking-based approach. Stocks are scored on value and growth characteristics, then assigned based on thresholds. This method allows for more dynamic movement in and out of the index, which can increase turnover and shift exposures more frequently. Neither approach is inherently superior. They simply reflect different philosophies of index construction. These differences show up in behavior, but long-term outcomes tend to converge. From 2016 through 2025, both ETFs delivered a similar total return of roughly 11.67%, despite very different paths along the way. Volatility, drawdowns, and timing of outperformance all varied, but both strategies ultimately behaved in line with expectations given market conditions. What matters most is not just the label value, but how consistently each methodology applies its rules across different environments. For example, CRSP-based funds tend to maintain more stable holdings, especially among large established companies. S&P-based funds tend to rotate more frequently as market leadership shifts. But despite these structural differences, long-term performance has remained broadly similar when measured across full cycles. This is the key insight many investors miss. Similar labels do not guarantee similar portfolios. When you invest in a value ETF, you are not simply buying exposure to undervalued companies. You are buying a specific definition of value encoded into an index methodology. That definition determines what enters the portfolio, what exits, how often rebalancing occurs, and how the fund behaves across cycles. Selecting a value ETF is not just a style decision, it is a structural one. Understanding the rules behind the ETF helps set expectations during periods of under or outperformance. Because in investing, the rules matter just as much as the assets. So the real question is simple. Are you investing in value or in someone else's definition of it?